The preparation of consolidated financial statements under IFRS 3 business combinations and IFRS 10 consolidated financial statements requires the parent company to measure the identifiable assets and liabilities of an acquired subsidiary at their fair values at the acquisition date, regardless of the carrying amounts recorded in the subsidiary's individual financial statements. Fair value adjustments ensure that the acquisition reflects the economic value of resources obtained and obligations assumed, providing an accurate basis for calculating consolidated goodwill, post-acquisition profits, and subsequent depreciation or amortization adjustments. In addition, IAS 36 impairment of assets requires goodwill arising on consolidation to be tested annually for impairment, ensuring that the carrying amount of goodwill does not exceed its recoverable amount. These requirements enhance the faithful representation and comparability of group financial statements. Fair value adjustments in business combinations. At the acquisition date, the parent recognizes the subsidiary's identifiable assets and liabilities at fair value, rather than at their carrying amounts. Any difference between book value and fair value constitutes a fair value adjustment, which affects both the calculation of goodwill and future consolidated profits. The fair value of identifiable net assets forms part of the goodwill calculation. Goodwill equals fair value of consideration transferred plus fair value of non-controlling interest minus fair value of identifiable net assets acquired. Consequently, higher fair values of identifiable net assets reduce goodwill, while lower fair values increase goodwill. Subsequent accounting must also reflect these fair value adjustments through additional depreciation, amortization, inventory cost adjustments, or liability settlements where appropriate. Fair value adjustments for depreciating and non-depreciating non-current assets. Non-current assets frequently require fair value adjustments because their carrying amounts may differ significantly from market values. Depreciating assets. Examples include property, plant and equipment, and certain intangible assets with finite useful lives. Where fair value exceeds carrying amount, the additional fair value increment increases the asset's carrying amount for consolidation purposes. Following acquisition, the additional depreciation arising from the fair value adjustment reduces consolidated post-acquisition profits. For example, machinery carried at $800,000 but having a fair value of $1 million at acquisition contains a $200,000 fair value uplift. This increment is depreciated over the asset's remaining useful life, reducing future consolidated retained earnings. The adjustment ensures that depreciation reflects the asset's fair economic value rather than historical cost. Non-depreciating assets. Land and certain indefinite life intangible assets are not depreciated. Where their fair values exceed carrying amounts, no subsequent depreciation adjustment arises. However, the higher fair value remains part of the subsidiary's identifiable net assets and therefore reduces goodwill at acquisition. Future impairment testing may nevertheless be required if recoverable amount subsequently declines. Fair value adjustments for inventory. Inventory may also possess a fair value different from its carrying amount at acquisition. If inventory fair value exceeds book value, the increase forms part of identifiable net assets acquired and reduces goodwill. However, once that inventory is sold after acquisition, the fair value uplift increases consolidated cost of sales, thereby reducing post-acquisition profits. The fair value adjustment therefore affects both acquisition accounting and subsequent profit measurement. This treatment ensures that profits generated after acquisition reflect inventory measured at its acquisition date fair value. Fair value adjustments for monetary liabilities. Monetary liabilities, including loans, provisions, and long-term obligations, may require fair value adjustment where contractual interest rates differ from current market rates or settlement values differ from carrying amounts. For example, long-term borrowings carrying below market interest rates may possess fair values different from book values due to changing market conditions. The fair value adjustment forms part of identifiable net liabilities acquired and influences the calculation of goodwill. Subsequent finance costs recognized within consolidated financial statements should reflect the revised carrying amount established at acquisition where applicable. Assets and liabilities not previously recognized. IFRS 3 requires recognition of identifiable assets and liabilities even where they were not recognized in the subsidiary's own financial statements, provided they satisfy recognition criteria. Examples include customer relationships, brands acquired through business combinations, licenses and patents, contingent liabilities measurable reliably, certain contingent assets where recognition requirements are satisfied. Many internally generated intangible assets cannot be recognized by the subsidiary under IAS 38 because their costs cannot be measured reliably. However, upon acquisition they may become separately identifiable and capable of reliable fair value measurement. Recognition of these additional assets increases identifiable net assets acquired and therefore reduces consolidated goodwill. Similarly, contingent liabilities existing at acquisition are recognized at fair value even if outflows are not probable under IAS 37, provided reliable measurement is possible. Effect of fair value adjustments on goodwill. Goodwill represents residual value after recognizing all identifiable assets and liabilities at fair value. Consequently, higher fair values of identifiable assets reduce goodwill. Higher fair values of liabilities increase goodwill. Recognition of previously unrecorded intangible assets reduces goodwill. Recognition of contingent liabilities increases goodwill by reducing net assets acquired. Accurate fair value determination is therefore fundamental to correct goodwill calculation and subsequent consolidation adjustments. Goodwill impairment. Under IAS 36 impairment of assets, goodwill is regarded as an indefinite life asset and is not amortized. Instead, goodwill must undergo annual impairment testing, regardless of whether impairment indicators exist. Goodwill is allocated to the cash-generating unit, CGU, or group of CGUs expected to benefit from acquisition synergies. The carrying amount of the CGU, including allocated goodwill, is compared with its recoverable amount, defined as the higher of fair value less costs of disposal, or value in use. Where carrying amount exceeds recoverable amount, an impairment loss is recognized. Impairment losses are allocated first to goodwill, with any remaining impairment allocated proportionately to other assets within the CGU. The impairment loss is recognized immediately in profit or loss, reducing consolidated retained earnings. Unlike other assets, goodwill impairment losses may never be reversed, even if recoverable amount subsequently increases, because internally generated goodwill cannot be recognized under IFRS. Financial reporting significance. Fair value adjustments and goodwill impairment are fundamental components of acquisition accounting and consolidated financial reporting. Fair value adjustments ensure that acquired assets and liabilities are recognized at their true economic values, providing an accurate basis for goodwill calculation and subsequent profit measurement. Goodwill impairment testing prevents overstatement of acquisition-related intangible value and ensures that consolidated financial statements continue to reflect recoverable economic benefits. Together, the principles established by IFRS 3, IFRS 10, IAS 28, and IAS 36 ensure that consolidated financial statements faithfully represent the financial position and performance of corporate groups while providing investors and other stakeholders with transparent, comparable, and decision-useful financial information.